Hey, good morning, options traders, and I hope everybody had a great weekend. And last week I posted an article talking about how the Dow Jones Industrials is about to form a golden cross. And of course, every technical indicator has its opposite, and the opposite of a golden cross is what's called a death cross. Same idea, just in the opposite direction. So I want to talk about that and show you why it's forming, and also why it's probably not as big of a deal as people are trying to make it out to be. But in order to understand that, we have to first back up and understand a little bit of a property of moving averages. And that is why the short-term moving averages are faster than the longer term. And you have to understand that before you can really see why we can form a golden cross or a death cross for that matter. And so sometimes this concept with the moving averages throws new traders. So let's start with this video, and then the next video I'll talk about the golden cross that's forming. So the moving averages, the first thing you must understand is that when you're looking at a moving average on your chart, you are looking at a block of time. And in technical terms, we call them a certain period moving average. So for instance, if we're looking at the 50 period moving average, what is that? Well, it depends on what your time frame is in your chart. If you have a 1 minute time frame on your chart where each candle represents 1 minute's worth of time, then you're looking back 50 minutes. If you're in a day chart where each candle represents 1 day's worth of time, you're looking back 50 days, and so on. So it just depends on the time period of your chart. So for the golden cross and the death cross, we typically use the 50 and the 200 period moving averages. But the thing that you have to understand first is that the 50-day moving average will be faster than the 200-day. And why is that, and what are some other properties about that? So let's start here and take a look at a simplified version of some moving averages. So to make the point, I'm going to use some numbers here. I'm going to count up to 10, and then I'm going to start counting down to 1. So you can think of these as closing prices for a stock. You could think of them as maybe averages for test scores that you're doing, some type of an average, and you'll see why they rise and fall. So to keep it simple, let's look at a 5-day block of time, let's say. So if we're going to calculate a 5-day moving average, we're going to start with the first 5 days. We're going to add up these 5 numbers, we're going to divide by 5, and you should probably recognize it's going to be this center number here, because we have a symmetrical distribution. So that's going to be 3. Our moving average is 3. But what happens tomorrow? If we're still in a 5-day moving average, we slide forward 1 day, and notice that I've picked up a 6, but I've dropped off a 1. That's a big difference, especially over a 5-day period. So it's going to have a big impact on that 5-day moving average. So if we add up these 5, divide by 5, we're going to get 4. So there you go, we move from 3 to 4. It's a 33% increase just for 1 day's time. Next day, what happens? Well, we pick up a 7, we dropped off this 2. So what's the average now? Right there in the center is a 5. So you can see what happens is that as time goes on, that this moving average is going to increase quite rapidly, because the picking up of this higher number does have a significant impact. But now here's where it gets interesting. Watch what happens as we start introducing, let's say, a downturn, and our numbers are falling. But watch what happens to our moving averages. So the next day, even though your eyes might be seeing, let's say if you're looking on a chart, that the numbers are falling, what's happening to the moving average? The next day, we look at these 5, and the moving average increased. It's now 8.6. Why? Because we picked up a 9 and we dropped off a 6. On a net basis, we have increased the amount that we're adding up. What happens next day? We've picked up an 8 and we dropped off a 7. So again, it's going to increase the moving average from 8.6 to 8.8. Next day, what happens? We pick up a 7 and we've dropped off an 8. Now we're going to start seeing it fall. And we're going to fall a little bit down to 8.6. Next day, what happens? Moving average falls to 8. and now it moves to 7. And then the next day it moves to 6. Next day it's going to fall to 5. But do you see what's happening? It takes a while before that moving average starts picking up all of the falling numbers. So that's why they're a lagging indicator. You can certainly see periods of time when the numbers are falling on your stock chart, but that moving average is rising. And this is why. Now, this effect is going to get more pronounced with longer-term moving averages. So what if we used a 10-day moving average? What's going to happen here? Well, it won't be as responsive. In other words, it's going to create a smoother, more stable curve. So that will always be true on your stock charts. The 50-day moving average is going to have a lot more, let's call it zigs and zags in it, than the 100-day. The 100 will have more than the 200. The 200 will have more than the 500, and so on. And if you're looking at a 1,000-day moving average on a one-year chart, it's going to appear like an absolutely straight line. So the smaller the number of that moving average, the more responsive it is. So watch what happens if we move to a longer-term moving average. Let's say we're going to look at a 10-day moving average here. We add up all 10 numbers, divide by 10, we get 5.5. What happens the next day? We pick this number up, we pick up a 9, but we dropped off a 1. So that sounds like on a net basis we've increased a lot. But we really didn't. Why? Because we've got so many other numbers here in between that are dampening that effect. So the moving average now goes to 6.3. From 5.5 to 6.3, just up a little bit. What happens on the next day? We pick up an 8, we drop off a 2. Again, it sounds like it should be a big impact, but not really. We've gone from 6.3 to 6.9. So as this 10-day window starts to move through time, eventually we will see these numbers start to drop. But do you see how it just takes a long time for these numbers to drop? And that's because we have so many numbers in the list that the addition of this day here, even though that might be a fairly big drop from 3 to 2, and we're going, hey, we picked up this 2 and we dropped off an 8, just isn't going to make a real big difference to the moving average. So that's an easier way to see why these longer term moving averages aren't going to be as responsive. So if we were to plot these two, this is what we would see. Here in red is the exercise we just went through with the 5-day moving average, and here is the 10-day in blue. So notice a couple of interesting things. First of all, the red one has much bigger swings. Look at this, it got almost up to 9 and down to 3. Where did the blue go? About 5.5 to about 7.5. See, the red curve has lower lows and higher highs, but the blue curve is relatively flatter. So that's the first thing that you have to understand. That's how your moving averages are going to work. The second thing to notice is that the shorter term moving average crossed from the high side down. Do you see that? It actually crossed. This is what's going to happen when we're looking at the golden crosses and the death cross. It's not that the blue crossed through the red crossed through the blue. Now the other thing to notice is that only at that time is when the blue curve can start falling. This red curve has to intersect it at its peak. That's assuming that we have perfectly symmetrical numbers like in our example, which in the real world isn't going to happen, but it will be close. It's going to intersect up here towards a peak. So think about it. The 10-day moving average was moving up, moving higher, as shown by the graph, moving higher, and then it starts to flatten out. But if it's going to start turning down, what absolutely must be turning down? The red curve. It's faster. So when they were equal, when the red curve and the blue curve were intersecting and they had the same values, if the red curve continues to fall, the blue curve absolutely must begin to fall as well. But you'll see it doesn't fall as fast. It's just slower to respond. So while we didn't do this in the demonstrations, I'm going to exaggerate it here. Let's count from 1 to 10, down to 1, back up to 10, back down to 1, and so on. And so as before, you can see the red curve has much higher highs and lower lows. The blue curve isn't quite as pronounced. It's more compressed. So the red curve can cross from the top down, and only then will the blue curve start to fall. And the red curve might cross from the bottom side up, and only then can the blue curve start to rise. So that's really the important thing to understand as to why we can get a golden cross and a death cross. So keep those points in mind when you're working with your moving averages, and hopefully those will make more sense. And then in the next video, we'll talk about the golden cross that's forming in the Dow Jones. If you'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. You can also instant message me right here in Facebook.